Get this, I spent the morning staring at bond yields, and they're telling a story that the Fed simply won't. We all know that the Fed raises rates to cool inflation and cuts them to boost growth. But here's the big question. Does it really change how much you and I spend? The Fed funds rate is just the overnight rate charged between banks, not between you and your credit card company. The prime rate, however, that's set by banks, and that is the one that actually touches yours and my life. It moves in tandem with the Fed funds rate, but with a lag and a spread. Mortgages, well, they're tied to the 10-year Treasury, and auto loans to 3-year Treasuries. And credit cards, well, they float somewhere above prime. Yeah, the Fed influences these things, but only indirectly. Credit card APRs are still above 20%, and they haven't budged much despite rate cuts. So whatever magic the Fed thinks it has, well, the data actually disagrees. And that brings us to the real driver of spending. That is called the wealth effect. Consumption has climbed from $11 trillion to $16+ trillion since 2005. That's almost 50% higher, barely interrupted by a recession or Fed policy. Why? Because when people feel they're richer, they spend more money. 2/3 of Americans own homes, and more than 60% own stocks at this point. When their portfolios or home values go up, guess what? They splurge. When the market drops, guess what? They cut back. So when the Fed tinkers with rates by 25 basis points, what they're really doing is tinkering around with the edges of confidence. The real engine is wealth perception. The Fed is just a spectator in an economy powered by the markets. So, your truth bomb for today is this. The Fed doesn't drive your wallet. The market does. Cuts don't create confidence. Gains do.